Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us here at AusBiz. Let's get across what happened overnight. And on Wall Street, stocks kicked off August firmly with the Dow closing at a record high as signs of de-escalating US-Iran tensions sent oil prices and treasury yields lower. Crude prices down around 5% after President Trump said talks to Iran to reopen the Strait of Hormuz are taking place, despite Iran denying that. Now, among the S&P 500's biggest advances, Meta, Microsoft, Oracle and Boeing all doing well. Amazon shares added to the previous session's gains as the company's market cap surpassed $3 trillion for the first time after its earnings results last week. Palantir surged some 11% after results far exceeded estimates and raised revenue and income forecasts for the full year. And tonight, SpaceX will report its first quarterly results since going public. Its stock has been trading below its $135 issue price for nearly 3 weeks after its debut in mid-June. Other companies with AI ties that are scheduled to report this week include Advanced Micro Devices and data storage companies SanDisk and Western Digital. The shares of US energy companies tracked the decline in crude prices, and shares in Marriott International fell after it forecast third quarter profit below Wall Street expectations as softer demand in the Middle East hurt hotel room revenue. Well, President Trump says talks with Iran are underway and has warned that he's prepared to decapitate the nation if it fails to agree to a good deal to end the 5-month-old war, saying, "I want to give them every last chance before decapitation. You'll find out today or tomorrow. I mean, they're going to quickly one way or the other. It's not very complex." However, Iran has denied that any negotiations are taking place or are planned, but did confirm that talks with Oman are underway to get more ships moving through the Strait of Hormuz. Well, US Treasury yields slipped as oil prices eased. The 2-year was close to 4.25%, the 10-year at around 4.7%. Australian 3-year government bond yield futures fell to 4.5%, the 10-year at 4.98%. The US dollar index was up around 1/5%. The Japanese yen holding gains above recent 40-year lows after Japan and the United States launched a rare joint yen buying intervention and vowed to take further action if needed to shore up the Japanese currency. And the Aussie is currently buying 70 US cents. Well, oil prices have fallen to a 3-week low after President Trump held off on a fresh attack on Iran in the hope of sealing a quick deal that could boost oil supplies in the Gulf. Brent crude falling around 5%, currently close to $84 a barrel. Gold edged lower on uncertainty over the war. Spot gold at close to $4,050 an ounce. Copper futures rose more than 1%. Iron ore down 1.5% at $95 a tonne. And Bitcoin currently trading at around $63,500 US dollars. So let's get across those market moves. Interactive Brokers Chief Strategist Steve Sosnick joining us again now. Steve, welcome back to you. That was a very positive session we saw on Wall Street. Why? Obviously, some optimism yet again over what we've heard in regards to President Trump and what's going on in the Middle East. But how many times have we heard this before? But obviously, falling oil prices helps. I mentioned the yen there, that intervention. And I see you also pointing out that perhaps investors thinking that spending on AI is a good thing after all.
Yeah, you pretty much hit my piece this morning, Andrew. That's really the way I've been thinking. I mean, obviously, the idea that that Trump called off another round of strikes on Iran. I was watching the evening news earlier in the U.S. and they did a supercut of all the threats and then reneging on the threats that have gone on. But yet, the question would be, why did oil not back off, give back some of its losses? And I think the reason would be I don't think the oil market cares. The oil market's apolitical. They want ships going through, and if it means they may have to pay a toll for some deal between Oman and Iran, so be it. I guess they'll just deal with it, and that's kind of it's not necessarily ideal, sitting where I sit from a U.S. foreign policy point of view. But again, I think the global oil market is agnostic. But as somebody did the count, it's at least five times he's done this. And I would argue intuitively there's probably been more fits and starts.
So when we look at a stock level, obviously this is in the wake of some of those key hyperscaler results we've had, but some amazing gains we've seen there, in particular the likes of Amazon, that built on the previous session's gains there, even Meta making a comeback after being hit hard. What have you made of those results?
Well, I mean, I think the results themselves were quite good. The market obviously is less squeamish about, some of the spending that's going on. We can ask ourselves, were the Microsoft numbers $600 billion worth of good? Because that's about the amount of market cap the company's put on since its report. Maybe a bit extreme, but this market doesn't do anything in half measures. So Amazon, Microsoft goes up, it goes up 15%. Amazon goes up, it goes up 13%. Apple goes down, it goes down 10%. Meta goes down 10% as well. Although today was a comeback just in many of these stocks, with Apple being sort of an exception. But you had, you mentioned Meta rising. You mentioned also Oracle rising. I mean, that stock, talk about coming back from the dead. So it just sort of seems like, okay, long live the old, out with the old theme. Let's move on to the new theme, and we just sort of swing from one extreme to the next. This may not be the easiest analogy, but I think of it as like going on a whale watching tour, and everybody rushes to the side of the boat when they see a whale, and then the whale swims under the boat, and everybody rushes to the other side of the boat to see it on the other side, and everybody just sort of rushing back and forth. Semis were a bit of a laggard today. In what I was calling the maker taker trade, meaning the market was favoring the makers of the technology, the semis and things of that nature, as opposed to the takers, the buyers of that technology. Today we shifted back in a big way to the takers. Spending is apparently good. I don't know how much of that is beginning of the month enthusiasm. I don't know how much of that is just sort of the feeling that maybe we've gotten one of the big sellers out of the way, that with the situational awareness fund blow up, and maybe these stocks are seen as being somewhat impervious to it. But this is not just normal, mild asset allocation. This is people racing from one set of stocks to another, and in some violent manners. Although, to be fair, today was a broad up day. But it went to should remind us one more time that if the hyperscalers are moving, if the biggest cap tech stocks are moving, so goes the market.
Steve, let me pick up on what you just said, a reference there to, let me borrow your cute headline, awareness of a leveraged situation. What is going or what went on there? Is it symptomatic of what we've seen, that FOMO, that MOMO on Wall Street in regards to AI?
Yeah, I mean, there's a lot to unpack in that situation. It was a guy who was, his early 20s, who admittedly was a brilliant guy. Graduated one of the top universities at 19, and went to work for the big AI companies. Wrote a very key paper called Situational Awareness. Turned it into a hedge fund that raised $3 billion off the bat. Then raised another $20 billion as it was just leveraging into the stocks that he perceived to be the beneficiaries of the AI trade. Again, the companies receiving all the massive amounts of spending, but his bankers let him lever up 4-to-1, and so that turbocharges the returns as you go up and you get more money and just pile it into a rising market. That's really turbocharged the returns. The problem is when it works against you. Leverage is nasty, and the other problem with leverage is you're basically in partnership with your lenders at that point, and you lose your say over your positions. If you buy $10,000 worth of stock with cash and it goes down 90%, it's your decision whether you want to sell it or not. If you've bought $10,000 worth of stock and you've levered it up 4-to-1, normally 2-to-1, but in this case 4-to-1 because he was able to get preferential leverage. If that stock goes down 25%, his equity is zero. Now, the funds don't, the prime brokers don't let it get there, but what they're going to do is demand more collateral, or they're going to demand that you sell some stock to raise money. But the problem is, if you're selling stock into a falling market, presumably you're fully invested, so don't have a lot of cash to pony up. The mere aspect of being a huge seller of leveraged positions into a heavily leveraged market has some nasty feedback effects. The market was, I think, very right to bounce once Citadel sort of put a tourniquet on the situation. And I'm guessing those guys made double-digit returns in about a day and a half, if that long. But the market took that as a sigh of relief. But it's very important to remember if you're trading on margin, you lose control over your ability to decide if you want to take a loss. It becomes your broker's decision, not yours.
Steve, let's move to the curious case of Kevin Warsh, the Fed chair, of course, chairing his second meeting last week. A lot of angst about, I guess that's that lack of guidance, isn't it? And how the Fed is actually going to bring inflation back to target. And I'm looking at the commentary, like a headline here, Kevin Warsh, he's an idiot or a genius. The market just cannot work this out. What do you make of it?
Well, I'm not going to go so far as to call him an idiot. I don't think that's fair. I think he's a very bright man. But he came to the job with central bank experience as a former Fed governor, pretty much in the global financial crisis days. He was a hawk. He was not in favor of a lot of the economic stimulus that proved to be necessary. But I think it's also a totally different job to be one of the guys as opposed to being the guy. Or the woman, let me not be sexist, but being the person in charge. And a lot hinges upon that. And he's someone who's already in a difficult situation because the market's come to expect a hawk, but yet they know that he was appointed by someone who advocates actively for lower interest rates. So he's kind of walking that tightrope there. He's portrayed himself as very much of a single issue, single mandate chair. I did some counting. He mentioned the word inflation 29 times during his press conference, and he mentioned the word labor 3 times during his press conference. In theory, they're supposed to have equal weights in the dual mandate. In reality, that's not what he's portraying. But yet, he's also not seemingly doing anything about it. He's trying to jawbone the market, and the bond market told us in very certain terms that they are not down with this. We saw yields zoom up pretty much immediately after he's finished speaking, and they've not really come back down since. We got a little bit of relief today because of the oil prices and because of the yen intervention. But the yield curve steepened dramatically, and that's the market telling you that they're concerned about long-term inflation. It also told us that the short end of the curve, we saw rates rise because the market doesn't think that a hike is coming anytime soon. They're now pricing in December, which, quite frankly, all along I thought was the most likely case because I think part of his reason for doing the various task forces was to buy himself some time. And certainly I don't think he's going to want to be in a position to draw the president's ire by raising rates ahead of a midterm election. So, if he's basically trying to tread water for another, 4 months, basically, market's going to have some issues with that.
Steve, as always, terrific analysis. Thanks for joining us on Interactive Brokers.
My pleasure, Andrew. Take care. Thanks.
A quick look where we're likely to open when we get going in just a couple of minutes. Flat. That's pretty uninspiring, isn't it? Despite what we saw on global markets, particularly those hefty gains on Wall Street. We'll get across that with a number of company results. Of course, we are now in reporting season. Join us for the open.